Good afternoon, everyone, and welcome to the simple.Capital monthly top-down meeting. At simple.Capital, we've got a rigorous investment process which combines looking at macro environment from the top down to drive our investment thinking, and that marries into a bottom-up analysis when we're actually looking at underlying portfolio companies to invest in. So welcome, everyone. I'd just like to touch on the agenda for today. So I'll just do a 2-minute quick intro to simple.Capital, who we are, and then I'll pass over to Marco, who will do a quick synopsis of what's happening in the macro environment globally. There's a lot of volatility and some turmoil, which we will look to try and help investors to navigate through. We'll then touch on a couple of mega trends, which we believe have got a lot of legs. So last mile delivery, as well as Proptech and the LATAM VC environment. We'll then circle up with a summary of global VC activities and notable deals that happened in the first quarter. And then we'll segue into an innovative product, which we believe we've pioneered at simple.Capital, which is a quarterly bundle, which gives investors exposure to global deal flow for as low as $1,000 a ticket. If there's time at the end, we'll then circle back to some Q&A from the audience. So who we are as simple.Capital. So we are a mission-driven entity, and we're out there to try and democratize access to venture capital. So giving investors access to world-class deal flow, giving them access at low entry price of $1,000, and also aspiring to procure liquidity in an illiquid asset class. We also believe that as part of the ecosystem, it's crucial to help founders actually navigate the opaque world of early stage funding rounds. Who we are as a team. 13 of us, a real blend of skills between tech, corporate finance, legal, and marketing. We've got 7 CAs, 3 CFAs, and 2 lawyers dotted around major South African cities, as well as in the UK. So with that, I'll pass over to Marco to just give us a quick overview of what's happening out there from a macro perspective.
Thanks, Blake. Just diving straight into a macro overview. The difficult macro operating environment continues, with the predicted likelihood of a recession in the next 12 months increasing to 28% from 18% in January. This is according to a number of Wall Street Journal economists. Whilst there has been an increase, this is still not the base case, and we don't expect this to be the most likely outcome. The market has been under some severe constraint this year, with some of the drivers behind this sentiment starting to pinch a little bit more. Global inflation continues to rise. Financial conditions have tightened and continue to tighten. The risk-off sentiment, meaning people moving away from what they deem to be risky assets, like high-growth tech stocks. There's been lots of volatility in commodity prices, and now there's an energy crisis in Europe. This macro fragility has been brought about by a number of global factors: continued impacts and slow recovery from COVID, China's zero COVID stance and the associated lockdowns, the war in Ukraine, and globally constrained supply chain challenges. Now, what does all of this mean? As the biggest economy in the world, when movements happen in the US, they are felt around the world, and inflation is generally something the US have not been accustomed to. However, it has reached its highest levels in 40 years in the first half of this year, getting as high as 8.5%. While this may not seem high when compared to the likes of Zimbabwe and Venezuela, who've been in hyperinflationary environments in recent times, it is high for the biggest economy in the world, where their targeted inflation is below 2%. Inflation has been brought about by a number of factors, including the creation of free money per se, through various central banks putting liquidity into the market through stimulus checks, and the increased demand for goods in a constrained supply environment. The war in Ukraine and renewed Chinese lockdowns have made an existing problem worse. The way central banks look to curb inflation is by raising interest rates, something we have already seen in a number of countries around the world, with further rate hikes expected across the globe. There's likely to be a 50 bp hike in South Africa this week. Now, this talks to the tightening of monetary supply and financial conditions tightening. This doesn't only mean your mortgage and your car repayments will increase, but it has other knock-on impacts, like bringing down the valuations of companies, mainly growth companies, and that's the reason for the tech sell-off, and the current negative impact on equity markets and emerging markets. Through all this uncertainty, people tend to move away from risky assets and move into things they construe as being safe. This talks to the risk-off sentiment. Moving in line with high inflation and expected rate hikes is consumer sentiment. The current situation in the global economy, compounded by the war in Ukraine and the consequences thereof, has seen a noticeable reduction in consumer confidence. The rising instability of energy provision and the difficult production environment in China, where 85% of manufacturers have reported shipping and trucking disruptions as a result of the lockdowns, is driving this lower consumer confidence. But just like COVID accelerated many enhancements in the modern world, the Eurozone are putting a large focus on being self-sustainable from an energy point of view, and this crisis is likely to accelerate their move towards renewable energy. Never let a good crisis go to waste. As the world continues to recover from COVID, we see the end of the war sooner rather than later, hopefully, and we fully expect to recover from any difficult macro operating environment and accelerate the fostering of global technological opportunities in e-commerce, FinTech, property, and many other technologically relevant verticals. Unfortunately for many investors who do not stick to the longer term horizons and investment thesis, this is where behavioral finance comes to the fore. People start panicking, selling shares, and hiding money under their mattresses. If history has taught us anything, this is the exact wrong behavior, and it's during these times where the biggest, cheapest, and best opportunities present themselves. I'll now pass over to Blake, who will give some guidance on navigating through the macro volatility.
Thanks for that summary, Marco, as always. So to summarize, we're in a challenging macro environment, and this is seen to persist over the short to medium term. We're facing rising rates, we're facing inflation, we're facing supply chain constraints, downgraded growth forecasts, as well as rising energy prices. Now, this might seem a lot to take in as an investor, but how, as an investor, do you actually navigate through this macro volatility? So our internal view at simple.Capital is, which Marco has alluded to, is you've got to take the long-term view. Behavioral finance really costs people significant growth return over the long term by selling at the absolute worst time. So take that long-term view and look through the cycle, especially if you're investing in a private asset class in an early stage business that has a significant growth trajectory ahead of it. So VC, by its nature, is a private asset class. And so there is a benefit of having a lack of mark to market. We've seen the sell-off in public tech stocks driven by higher discount rates and a lower growth trajectory. And this is where behavioral finance comes into play. However, we crystallize value uptick on a priced equity round basis. So essentially our investments are at cost up until the point that there's a value crystallized at the next priced equity round. It's also important to look through. So we focus on the tech sector, but it's also really important to look at on a sub-sector basis. So there are certain industries that are less cyclical than others. And so I think it's important to look for bottom-up exposure in those less cyclical subsectors. You've also got to try and pick the winners. Obviously, that's easier said than done, but we really feel that capital will be abundant for the top one or two players in a particular market. The smaller players that have exhibited less traction may struggle to attract capital in a more difficult environment. Another risk mitigator is to also look for businesses that have exhibited more traction and are raising a later stage funding round, such as a Series B. We think that the instrument also plays a role in navigating volatility and a difficult environment. So looking at convertible notes, sometimes secured, sometimes unsecured, but you're in a debt note, which is higher up in the cap stack. Or looking at revenue-based financing opportunities, whereby the debt is serviced through a percentage of the monthly revenue generated by a business that's typically got a revenue profile that is recurring in nature and subscription-based. So we believe moving up the cap stack into convertible notes and revenue-based financing is also another risk mitigator. And what's also important is when you're looking at convertible notes and you're looking at safe notes, for example, that have a valuation cap, it's important to note that this is the highest valuation that you would ever convert into equity. And so typically these instruments are bridge rounds, and there's later priced equity rounds 6 or 12 months later. In the event of a valuation correction and a lower valuation being achieved in that priced equity round, you would convert at that lower valuation versus the cap. The cap is the highest valuation that you would ever convert at. So these are just a couple of ways that we believe investors can take the challenging macroeconomic environment into account, but invest with a risk hat and looking through the cycle. All right, that brings us to our next section. So what we'd like to do is zoom into some mega trends that we find particularly interesting. So Marco is going to take us away with last mile delivery, and then Cabello is going to take us away with Proptech and the LATAM VC environment.
Thanks, Blake. So yeah, like Blake said, this month's focus is on last mile delivery, something that we've deemed to be a mega trend. And there's a lot of tailwinds and industry growth potential in this specific vertical, which we're quite excited about. And here are just some numbers for you guys. Last mile delivery is expected to grow from 100 billion market in 2020. We haven't received the 2021 numbers yet, to over $400 billion industry in 2027. By 2030. This exudes a CAGR of 10%. Bain reported that the e-grocery market, which is a specific niche within last mile delivery, just in the MENA region alone, expected to grow to 26 billion by 2025. Another positive tailwind, the growth of the middle class and large digital penetration and internet usage in these regions is going to be a catalyst for growth for on-demand delivery and instant access of goods. There's an increased implementation of smart technology and automated systems, similar to Internet of Things, which has allowed companies to use real-time information to improve the end-to-end process and facilitating the exponential growth of last mile delivery. Like everything, the industry is not without risk, so there are some risk considerations that we look at. The last mile delivery portion of businesses often makes up more than 50% of total shipping costs. Businesses using or relying on last mile delivery often consume a lot of capital, so they're quite capitally intensive, and this leads to large margin compression. The large capex required to establish effective solutions in a competitive market makes it quite difficult. But again, like Blake said earlier, it's important to sort of pick winners in this space. It's quite a complicated area with technical delivery networks, complex technology solutions, and warehousing. However, we at simple.Capital are really bullish on this vertical. It's primed for growth in various jurisdictions. There's a number of companies that are raising a lot of money in this space and have exuded very high valuations. So we're really bullish on the growth. Some areas are more attractive than others. I alluded to the growth potential in MENA, which is something, again, we're really excited about. There's specific geographies that benefit from cost arbitrage and result in these companies being margin positive a lot quicker than other regions. In an industry or in a time where these businesses are operating, they're primed for growth because of how much of a remote working world we live in, how digitally driven the current environment is, and the e-commerce and instant gratification environment which we're currently in. We believe there's enormous potential for growth in the sector, and specifically in the MENA region. In close proximity to MENA is India, which have a number of extremely successful and highly valued last mile delivery businesses. Zepto, a 10-minute grocery delivery business in India, was valued at 900 million last month, and Swiggy, an Indian food delivery business, raised over $1 billion at a $5.5 billion valuation in this last quarter. I'll hand over now to Cabello, who will take us through some LATAM and Proptech megatrends.
Thank you, Marco. Just taking a different view, we're starting by looking at the region first and then zoning in on a particular trend within that region. Focusing on Latin America as an investment region, they currently have a population of over 650 million people. And looking at it size-wise, it's the same size as Southeast Asia, but double the GDP. And in 2021, there was a breakout year for venture capital funding for companies with companies raising over $15 billion across 772 deals. And this was quite a feat, considering that this value, the sum value of $15 billion, was more than that was invested in the past 7 preceding years. Within 2021 as well, there were 16 new unicorns that were minted, with some of them as recent as 2020, being founded as recently as 2020. And one of the biggest drivers with this is towards the funding and everything that's been happening within LATAM as a region was, the digital adoption that's been driven by the pandemic and the need to really go digital. And since they have been starting on a lower base, their adoption pace has been quite high of late. Just looking back to the kind of sectors that received funding in this period in 2021, FinTech led the sector with 39% of funding going towards that. The second being e-commerce at 25%, and the last being Proptech at 9%, which is the sector that we're going to focus on a little bit more in just a second. Just going back to the global venture capital slowdown and global macro conditions that are actually surrounding the world, there has been a slight decline in funding for Q1 2022 within the LATAM region from a value perspective, but there have been more deals that have been done between Q1 2022 and Q4 2021. And even having said that, there's been a decline in the amount the value that's been raised and backing companies within this period between Q1 2022 versus Q1 2021 is still higher in this period, just showing that there's still quite a bit of legs within the region. Just focusing and zooming in on PropTech now, being the third biggest sector within LATAM for receiving funding. Despite the really large population, the market in terms of technology use in the property market is quite unsophisticated from a Latin perspective. The big property market players are the brokers, developers, real estate agents, administrators, and so on. And the market is is not consolidated at all. And that's where the opportunity then lies. The fact that there's more opportunity to use technology to solve existing problems. There has been a huge drive and a huge growth within the PropTech market from the tailwinds of the COVID-19 pandemic as well, and the digital adoption. And one of the key things within the market that they'll be looking at is actually looking at what developed markets have done, like Europe and USA, and really learning, adapting, copying and improving what needs to be for solution-based things within the LATAM region. There has been, in terms of the top 10 deals that were actually done in Latin America last year, 2 of them were within the PropTech market, with Loft and Quinto Under. Loft raising $525 million last year, which is a real estate marketplace for selling and buying property, and Quinto Under as well, an online real estate marketplace that raised $420 million in 2021. So in terms of the focus areas where PropTech will be growing, really are the areas where there are online services and digitizing everything within the supply chain of real estate. platforms for easier rental and selling of properties like Loft and Quinto Under, and also real estate as a service, where we're looking to see companies come up with more efficient ways of doing things within the value chain of real estate, which could be providing access control products, which could be providing products that help financially the back end of how you run your real estate communities and so on. And definitely, given that they are still quite unsophisticated, this is where there's a huge opportunity for growth and expansion that we're hoping to be a part of, and we'll be keeping an eye on going forward. Thanks, Marco. I think we'll look at a bit of the deal activity and VC activity going forward for the past quarter.
Thank you, Cabello. Yeah, while you zoomed into LATAM and the Proptech sector, I'm going to zoom out a little bit and look at some global VC activity over the first quarter. So global venture funding reached $142 billion raised across almost 9,000 deals in Q1 2020. This was the first full quarter-over-quarter in a year from a historical record in Q4 2021. So while there was a slight reduction, it was only a very small reduction coming from historical quarters in 2021. Even with this, there was still an increase on the comparable quarter, which was Q1 in 2021, actually a 7% increase. So whilst there was a slight slowdown in deal activity, the growth in number of unicorns signifies that quality businesses will continue receiving funding, as there's lots of dry powder in the market. Dry powder, just money that's been raised by funds and ready to be deployed. So there's a lot of venture capitalists who won't be sitting on their hands and are still going to be deploying capital despite the difficult macro environment. It's anticipated that there will be a 6 to 9 month lag in valuation compression in private markets relative to public markets. This is nothing new and nothing that's completely unexpected. We do sort of forecast this, and it's been seen before, but again, it's not a travesty. We are aware of the view that this will be felt, we're of the opinion that this is going to mainly be felt by companies raising Series C onwards as they raise more capital at higher valuations. At simple.Capital, we invest in early stage companies, pre-seed, seed, Series A investments, and we don't foresee this portion of the market being as heavily impacted, and expect quality companies to continue being able to raise capital and expanding their businesses. The low rounds in US-based startups signifies geographic diversification, much like our Q1 2022 bundle, which we'll go through in detail a little bit later, and sees funding moving into different geographies across the world. You'll see in a slide coming up the size of deals in different jurisdictions around the world. Lots of US startups have raised enormous quantums of VC funding to solve very specific problems and challenges in their local markets. So previously underserved and undercapitalized markets are now getting more VC funding and their piece of the pie to solve some macro problems in enormous markets. Like Cabello's just taken you through LATAM and the Proptech opportunity there. There's huge opportunity in MENA, Africa, and Southeast Asia, with all previously underserviced or undertapped with regards to VC funding. So continue looking at some of these graphs with the VC activity overview in the first quarter. Seed funding was the sole funding stage that grew over prior quarters in Q1, where it reached 10.3 billion. Again, a lot of the companies that we invest in are at this stage. So whilst there was a slight reduction in this quarter relative to last quarter, the seed stage, there was actually an increase in funding. And this is something, again, that we don't necessarily forecast slowing down. Early stage funding brought in $5.1 billion. This was down 18% quarter on quarter, early stage funding being one step further than seed. And then late stage funding and technology growth funding was down almost $100 billion in Q1. But again, 100 billion off a very, very large, only represented a 12% reduction quarter on quarter. Despite the reduction in funding deployed, again, small number, The newly minted unicorns totaled 129 companies in the first quarter of 2022. It was down from 146 newly minted unicorns in the fourth quarter of 2021 and 132 crowned in Q1 2022, but it still has taken the number of unicorns to a record. Whilst the venture funding market in Q1 2022 was not as strong as the 3 prior quarters, the trend does not suggest a decline to pre-2021 dollar amounts invested. Venture firms across the ecosystem have raised ever large funds with smaller intervals between funds, while private equity doubled down on investing in private companies, leading many of the largest funding rounds in 2021. Leading venture firms are not showing a slowdown in investment pace for the first quarter, with some of them actually picking up their pace, deploying more capital into more deals relative to past quarters. However, the turbulence in public markets can't be ignored and is likely to have some sort of dampening effect on late-stage financings and valuations. Seed and angel, just to give a bit of color to these graphs, seed and angel rounds consist of seed, pre-seed, and angel rounds. Crunchbase also includes venture rounds of unknown series, equity crowdfunding, and convertible notes at $3 million or less. Early stage consists of Series A and Series B rounds, as well as other round types that don't have information disclosed. Crunchbase includes venture rounds of unknown series, corporate venture, and other rounds above $3 million and less than or equal to $15 million. Late stage consists of Series D, C, D, E, and anything later than that. And this also includes venture rounds of unknown series, corporate ventures, and other rounds that are over $15 million. Just pulling up a slide that I referred to earlier. These are the top 10 global funding raises in Q1 of this year. And just if you look at the third column, it sort of shows the startups and where they're based around the world. There's only a repetition of the US, which featured twice in the top 10, and France in the top 10. And this truly does show the complete global diversification of funding. If you had looked at this table, a table of its ilk, a couple of quarters ago, you would have seen a lot of US companies. So it shows a lot of global diversification and a lot of opportunity in other global segments around the world, which we're really, really positive about. To take you through the Simple Capital Q1 bundle, which we've sort of touched on a couple of times in this presentation, I'm going to hand over to Blake, our CIO, and Tim, our CEO.
Thanks, Marco. Just before we jump into that, just to summarize. So, as part of our top-down process, we look at what's happening from a macroeconomic standpoint. We've painted that picture clearly. We then like to look at the venture capital global industry from a helicopter view and what's happening. And I think the clear story is that throughout COVID and throughout 2021, funding into VC tech businesses was supercharged. There's been a slight slowdown in Q1 this year, sequentially from the peak in Q4 last year, albeit if you look over a longer period of time, that level in Q1 is still very elevated compared to prior years. And then, to guide our investment decision-making from a bottom-up perspective, we believe a rising tide, floats all ships. And so we look at subsectors that we believe have legs. And so we've depicted for you, the LATAM environment, Proptech environment, and last mile delivery. So that kind of concludes the overview section of today's webinar. We'd like to touch on the Simple Capital bundle. And with that, I'll hand over to Tim.
Thanks, Blake. I think just to echo your views, I think what we do when we're looking at building a bundle is we look at these mega trends and we look for things that are interesting in those mega trends. To invest with us into one of our bundles, we've said a number of times today, you can invest from $1,000. However, you do have to meet one regulatory requirement, which is the sophisticated investor definition in the United Kingdom. And it's one of these 4 requirements. So you are either a member of a network or syndicate of business angels, 2, you've made an investment previously in the last 2 years in an unlisted company. 3, you work in your professional capacity in the private equity sector or the provision of finance for small and medium enterprises. And 4, and it's an or, not an and, 4 is you're a director of a company with an annual turnover of at least £1 million. So as long as you meet one of those, it's a self-certification, and you do it as you conclude your investment. If you have any questions on that, please feel free to reach out to us as the team, and we can always help you work out if you meet that definition or not. Great. Blake, do you want to take us through just some of the key differentiators on the investment bundles?
Sure. So thanks, Tim. So we're excited about the bundle concept, and a couple of reasons why. We have a Venture Scouts program whereby we have 50 plus Venture Scouts that are sitting strategically placed in the hottest startup jurisdictions globally: West Coast, East Coast, Tel Aviv, London. They show us in deal flow that is curated and high quality. This is then vetted internally by our investment team. So it is really global, curated and vetted deal flow. We are dashing down the barriers to venture capital as an asset class. Previously, the stomping ground of high net worth individuals, family offices. Now we believe that at $1,000 a ticket, this opens up to a more broader retail base, albeit the still requirement to be a sophisticated investor, but lowering those barriers to entry and making it more affordable. At simple.Capital, we are aspiring to provide liquidity in an illiquid asset class, which is a major benefit. So with our pref share structure, we can procure on a willing buyer, willing seller basis, a trade in and out of positions. And it is aspiration that we develop more technology around a marketplace in this regard. And then with these bundles, we also believe that having 3 or 4 companies in the bundle gives adequate downside protection through diversification. I'll just carry on with our mandate just to give you a flavor. Like, how do we look for these deals? What do we look for? And at a very high level, we are investors in the tech sector. So we'll invest from pre-seed up to Series B, but it's a tech or tech-enabled business. We look for, again, another risk mitigant is looking for IP that's protected in an investor-friendly jurisdiction. So, we definitely have emerging market exposure, albeit the IP is domiciled in a Delaware, in the Netherlands, in the UK, for example. With the link to emerging markets, we often love businesses that can scale globally, earn hard currencies, and also take advantage of an arbitrage whereby they're incurring low-cost emerging market local currency costs and generating those hard currency revenues globally. Backing the jockey is a phrase that we're all familiar, but it is incredibly true. We look for founders that have done it before, so built or exited, or had the relevant experience in the particular subsector that they are launching their business in. And then we always ask, why does the founding team and the C-suite get out of bed in the morning? I mean, what is this business doing? What is the reasons for existence? And what is its massively transformative purpose? And this needs to be clearly articulated by the top tier management. I'll carry on. Just to give you a flavor, so this is prior to this bundle that we're speaking today. There's another 4 companies that will appear on this list. And as you can see, we really have, albeit we domiciled in the UK, we have a global mandate. And this is depicted clearly on the slide. So, you're looking at Canadian exposure with Builder, a home renovation marketplace, expanding into the US. Lula, you've got an online grocery delivery platform in the US for convenience stores. We've got exposure in LATAM in Peru with Curios, which is an edtech business, which is a cohort-based online learning business, edtech business for professionals. In the UK, our stomping ground, we've got Retara, which is a rentable fashion business. We've got MakerSuite, which is a talking head video platform, and we've got Moment, which is a NFT social media marketplace. In the Netherlands, we've got Flex Club, which is a vehicle subscription service with underlying opcos in South Africa and Mexico. South Africa, where many of us at Simple Capital were born and or maybe living, is Sweep South, which is the largest Pan-African home service platform, recently acquired an Egyptian business and also expanded into Kenya and Nigeria. Plentify, smart energy business, testing the South African market, but aspirations to launch into the US. And Yebo Fresh, which is tackling the underserved lower LSM markets in South Africa for online food and FMCG delivery. So that just gives you a highlight of the investments to date, excluding the bundle investments, which we'll touch on right now. So over to you, Tim.
Thanks, Blake. So yeah, very exciting to go through this quarter's bundle. So I think firstly, we've looked at over 400 companies to get to this point that we can select 4. And I think, Blake's obviously been through the mandate now, but themes, like one of the strong themes that goes through this bundle specifically is strong traction with all of these companies and experienced founders. And we see experienced founders being one of 2 things. One is that they've either done this before, so they've been a founder previously and they now founded a second business, or 2 is that they're a subject matter expert. So they're like an expert in AI, and they're building an AI type of business. So those are the kind of folks we're looking for. You can see there's a lot of geographic diversification. We've got Proptech in Thailand, although registered in Singapore. Last mile delivery in Egypt, looking to conquer the Middle East and North Africa. A security-based tech business in Panama called Munily, and a FinTech in San Francisco in the US. I'm going to go through each of these businesses in detail and give you a bit of a synopsis as to what do they do and why we're excited about them. So if we can move on to the next opportunity. So here we've got Front. Front is a companion app for retail investors. They have over 120 integrations where they bring sort of information from brokers, crypto exchanges, and other wallets into one app where you can see everything. So if you look there, often people have equity investments in companies like or via brokerages like Robinhood. They have NFTs in OpenSea. They have crypto on Coinbase, and they have private market investments on AngelList or Carter. And it's difficult to know, all these alternative assets that you have, how do you know actually what are the values of all these things in one place? And Front is the companion app for doing that. They are also bringing in more traditional finance options, so bank accounts and more traditional products. But what's really exciting about this product is not only what they're doing, but how many people are using this product. So since their launch in August 2020, they've got 120,000 registered users already with minimal advertising, and they're already up to 15,000 daily active users. The CEO has a very strong track record, having exited a business called No Password before. And No Password used a lot of APIs to transfer confidential information, mainly passwords, between different applications. And a lot of that similar way of thinking and doing things is brought into the Front way of doing it, because now you're transferring confidential financial information. So he really is an expert in this area. So both a subject matter expert and an experienced second-time founder. In a short space of time, they've already spun up over 120 custom API integrations. And this is where the real moat sits. Is once they've built these API integrations, it's difficult for anybody to come in and and copy them, because there's just so many of them that they would need to spin up and replicate to have the same functionality and information availability as Front. And they're already backed by successful VCs, accelerators, and angels, even though this is only a seed round at this point. So that's Front, a really exciting fintech-based company. Now we're on to Munily. So this is a LATAM-based Y Combinator alumni company. So Y Combinator is obviously an excellent program. 400 business companies from around the world every 6 months being taken through the Y Combinator program. Generally, these are super strong businesses, and there are multiple unicorns that have come out of this program in the last 10 years. So it's definitely a good area for us to source. And what Munily is really trying to do is build a seamless access control solution for residential communities. So those folks who are based in South Africa will be familiar with, arriving at a new apartment block or complex and being asked to fill in their details into a book. And when they do that, one wonders, where does all that information go? And Munily is really replacing and automating that process and taking a lot of friction away. It's taking decision-making away from the guards who traditionally make decisions about entry or not, and giving that to the resident, etc. They've already grown to $500,000 of annual recurring revenue, and they're growing at 22% month on month, which is fantastic growth. And they continue to grow at this rate, mainly from a very clever distribution strategy. They've got in touch with a lot of the security companies in Panama and in Colombia, where they are actually partnering with them. So these guys already have the contracts to guard the residential communities, and they're now just adding the technology layer to that. So they don't actually have to do a first-time sale on that residential community, which has resulted in them having 9% market share across Panama and Colombia. Well, across Panama, and they're now expanding into Colombia. 8,500 of their users are using them every single day to let people in and out of their complexes. And this business has been a big beneficiary from COVID, because more people are getting e-commerce deliveries and more things are getting dropped off at apartment blocks and complexes. And consequently, access is becoming a bigger challenge that these I suppose properties have to manage. And so Munily is really solving this gap and has found excellent traction so far. So again, another business exhibiting really strong traction. Then on to Egypt. We've identified Rabbit, who are the quick commerce leaders in the Middle East and North Africa. It's based in Cairo, and they are an e-grocer who delivers items in less than 20 minutes. If you're in South Africa, think Checkers 60-60 in 20 minutes, so 20-20. Or if you're in the UK, Europe, the US, think about companies like Joker, GoPuff, Gorillas, Getter, etc. It's a similar model. Why do we like these guys? Well, they are the front runners in Cairo, and we know what a big opportunity both Egypt and the Middle East and North Africa is. So being the front runners, we expect them to do extremely well. There's a lot of capital flowing into this sector. And I think the thing is, if I think back to ride sharing, which was, the craze probably 8 to 10 years ago, it wasn't a case of whether ride sharing was going to be here to stay. It was who was going to be leading that. And I think quick commerce is a very similar business. It's not a question as to whether quick commerce is a business model. It's a question of who's going to be the leader and who's going to be the winner in each of these markets. We think that Rabbit will be the winner in Egypt and have a good chance of doing that in the Middle East and North Africa as well. They've already had the biggest pre-seed funding round in Africa at $11 million. The CEO, Ahmed, has exceptional experience, having been the general manager of Uber Eats in Cairo, as well as the general manager of Delivery Hero, who are both involved in this, quick, fast delivery space. They've managed to grow 9x in the last 5 months. A couple of months ago, they were delivering 1,400 orders. I'm sure that's nearly 2,000 orders a day now. They already have all the tier one global investors backing them, again, on this thesis that the quick commerce is here to stay, and it's a case of backing the winners in each market. Huge opportunity, as I've mentioned, $26 billion according to Bain. And finally, these guys are on track to hit $70 million of annual recurring revenue by the end of the year at a 15% contribution margin. And I think what's really interesting, and I think there's a visual on the next slide, is that in MENA, the average cost of delivery compared to the average basket size is significantly lower than in some of these first world markets. So for instance, delivering some groceries or a basket of groceries to a user in Egypt, because of the cost of labor is so much lower, it's much cheaper than doing that in say, Amsterdam or London or New York. And so there's a strategic advantage here to the business model that Rabbit are taking advantage of. Great. And then the final business that we're excited about is Property Scout, based in Bangkok in Thailand. They already have over 154,000 listings. These guys are the biggest realtor in Thailand already, and they're only focused on Bangkok. And they're a little bit different to just an agent that shows you the property. They actually facilitate the rental. So all of those cash flows that are traditionally, go just between landlord and renter or lessee are now transitioning through Property Scout as it's building trust in the market. And you can see that in the recent few months, they have moved into the world of buying and selling property as well. So they don't only do rentals now, they also do home acquisitions. As I said, four times bigger than any other realtors in Thailand. They're buying up a number of those realtors already to get access to their books. In the last 12 months, they did just under $2 million of annualized commission, which is a proxy for revenue. One of the reasons why we really like this, and it was mentioned earlier in the chat, was this is a proven business model. You're seeing companies like this biker in China, valued at over $32 billion, Quinto Anda and Loft in Brazil, also getting significant valuations there, and proving that this is a real need in emerging markets. And Property Scout, we think, are the right company to do this in Thailand. And again, we've got an experienced second-time founder who previously exited a business, Hotel Quickly, in Thailand. So a business with strong traction and a second-time founder meeting the bundle theme as well as the investment mandate. So that's the summary of the 4 companies that are in the bundle. We're really excited about this bundle, and maybe it's a good opportunity to hand back to Blake to just talk about some of the macroeconomic trends that we think are, facilitating growth. Okay, firstly a summary of the bundle. So I'll hand over to you now, Blake.
Sure, thanks, Tim. So Tim's walked us through in detail the 4 companies that we've deemed to be the most exciting in our pipeline, and we've included in the first quarter investment bundle, which we are looking to wrap up in very imminently. So just to summarize for the people who like tables out there, so you can see typically a seed to pre-series A exposure, the round size ranging from 2.5 up to $10 million. Instruments are safe and convertible notes, and if you just turn a page back to my earlier comments with the safe, you've got valuation caps whereby that is the most that you would ever convert at. And subsequently, should there be a re-rating of valuations lower before the priced equity round, then, we would convert at that lower valuation. We've depicted some of the monthly revenues there. So Tim's overarching theme of traction and with regards to Front, they've just turned on revenue after exhibiting enormous traction in terms of users and daily users. So really just starting to monetize. And to speak to the diversification notes on the bundle, you can see 20 to 30% exposure into each of these underlying companies. So you'll get exposure to 4 companies which really, we believe, protects downside risk. I'm going to hand over to Marco and Cabello to tie the two parts of this webinar together. So we've talked about macro, top-down. We've talked about bottom-up selection of attractive assets in this bundle. How do we marry the two together?
Yeah, just looking at some of the macro considerations on the bundle companies, from the various considerations that we looked at, including the rising interest rates, inflation, supply chain constraints, the downgraded growth forecasts, and rising energy prices. From a front consideration, I think three of these really do affect front, in the sense that rising interest rates, inflation, and the downgraded growth forecasts really actually increases front's defensibility position, in the sense that the key market users are people who want to stay abreast of their portfolio amidst any of the market changes that are happening, and this portfolio aggregation tool makes it so simple. In terms of supply chain constraints and rising energy prices, those won't necessarily affect the front user from the get-go, but perhaps when looking at their underlying portfolio, that really does give them a view of the underlying performance of equities and other investments that may be aggregated onto the platform. In terms of Unity, from an access control perspective, many of these considerations are actually neutral or do not affect them quite significantly, being the supply chain constraints and rising energy prices, but definitely where rising interest rates may not immediately affect Unity, the inflation that could potentially follow on the increase in prices could, but this is really mitigated through the fact that access control is a security need, and because it's a security need, this will be used no matter what the pricing may be. In terms of supply chain constraints and rising energy prices, they are not really key macro considerations from a Unity perspective. I'll hand over to Marco to just go over Property Scout and Rabbit quickly.
Thanks, Cabello. So starting off with Property Scout, I think the team is quite neutral on the impacts of the supply chain constraints, the downgraded growth forecast, and the rising energy prices. One thing we can say, though, around the supply chain constraints, that Property Scout already have a really strong supply funnel. Their product is not technically complex, so they're not overly reliant or hindered by the shortage in chips and semiconductors that is being experienced around the world, that a lot of the motor vehicle industry are struggling from. High inflation is always going to impact properties, whether you're buying or renting properties. So we do fear that could be a little bit of a constraint on Property Scout. However, linked with the rising higher inflation is rising interest rates, which we think is actually quite positive for Property Scout at the moment. The biggest portion of their business is the rental properties and the volumes they have there. So we foresee a lot more properties being rented and using Property Scout's platform to find the properties to rent as the cost of ownership increases. With Rabbit, we don't think the rising interest rate will have significant impact on them. They are not servicing any long-term debts at the moment, and they've got really favorable working capital credit with a lot of suppliers. Touching on that, the suppliers, where there is supply constraint, we don't think it is necessarily a big issue for Rabbit. While it's always going to challenge the type of business they're in, they do have a really diverse base of hundreds of suppliers. So any issues there will be mitigated through the extensive diversification. Higher inflation and the downgraded growth forecast will play into Rabbit's hands, we think. With the rising costs of going out and eating in restaurants, we think people's propensity to dine out will reduce, and they'll be ordering more groceries and eating at home to save on costs of going out and spending luxurious money on dining out or those types of experiences. From an energy price point of view, we do think it will be a little bit of a challenge over the next little while, although they do use motor vehicles which are super light on fuel, but there will be some margin compression with slight increase in delivery costs. But overall, from the current macro trends, we think Rabbit are really well positioned to gain a lot of traction in the market and do really well in these difficult times. I'm just going to hand over to Blake to take us through the summary of the investment vehicle and how the investment into this bundle will work.
Thanks, Kabelo and Marco, just for the macro overlay in the bundle. And I think the clear takeaway is that there are risk mitigants to a tough macroeconomic environment in the underlying companies. So just touching on the structure of the investment bundle. So we are domiciled in the UK. Simple.Capital Partners Limited is the investment partner to the investment company, which is Simple.Capital Limited. Type S preference shares will be the instruments that investors will subscribe to, and that will give you the underlying exposure to Munili, Rabbit's, Property Scout, and Front. In terms of the minimum investment, or price per share, I mentioned before, $1,000. The fees are 5% upfront, once off. And so you, compared to the typical 2 and 20 model, over the course of the life cycle of the investment, this is way below market. There's no annual fees, and the carry, once you get your capital plus your costs back, we only take 5%. So again, way below market in terms of the industry standard of 2 and 20. So hence our goal to really democratize and give increased access to retail investors into this asset class. There's a number of ways that you can pay. We've tried to make it easy for you. So bank transfer, credit card, even Bitcoin and Ethereum, Apple Pay, Google Pay, and PayPal. So just to wrap it all up, the process from here, again, we've tried to make it easy. So please indicate your interest. There will be KYC required for investors. And then we'll get you to sign your subscription agreement and then execute on your committed quantum of investment. So that basically brings us to the end. Just to conclude, I think the key takeaways from today's discussion are, yes, there is macroeconomic volatility. Yes, it's a challenging environment, but there are ways to navigate through this. And just to reiterate, taking a longer-term view, VC is a private asset class, so there's a lack of mark-to-market. Convertible notes and safe notes typically have a cap whereby if there's a lower executed valuation at the price equity round, you'll convert at that low amount. The cap is the highest amount you will ever convert at. And so for those of you concerned about valuations in the VC asset class, in terms of instruments, again, reiterating, convertible notes and revenue-based financing opportunities allow you to go further up in the cap stack relative to equity. And just to wrap it up, we believe that despite a challenging environment, our selected underlying bundle companies have macro risk mitigants in place. We've got a couple of minutes. If there's any questions, we can field them. But otherwise, thank you everyone for your time. We do this on a monthly basis, and we really believe that our top-down meeting drives our investment process.